Hi and greeting to our respective lecturer, Dr. Muhammad Sohail. So today, my group members and I will be presenting about financial analysis between two companies, which are Dutch Lady Milk Industrie Berhad and Farm Fresh Milk Sendirian Berhad. Before we start, I'd like to introduce my group members. This group contains 5 people, which are me, Ellen, Liana, Husna, Kenneth, and Azoni. Without further ado, let's move on to our presentation. Let's talk about company background for Dutch Lady. In Malaysia, Dutch Lady Milk Industrie Berhad was founded in Petaling Jaya, 1963, in Selangor. For 15 years, they have observed and analyzed the changing lifestyle of their customers and tried to meet their nutritional demand effectively. Dutch Lady Milk Industrie Berhad is a leading dairy company with a multinational management framework that focuses on a strong local presence to stay close to its consumer in Malaysia. Today, Dutch Lady Milk Industrie Berhad is a 600% firm that distributes a wide range of quality and delicious milk-based dairy products from powdered milk, engineered milk, cream to fresh and UHT milk. Let's see company background for Farm Fresh. Farm Fresh is a local brand and was founded by Low 20, who sell daily fresh brand because he found many Malaysian brands selling powdered milk. Although Farm Fresh is a new brand in the industry, it is already well known throughout Malaysia. Farm Fresh also gained popularity both nationally and internationally. The company also has 5 farms across Malaysia and has exported products to Singapore and Brunei. At the beginning of establishment, Farm Fresh founder Low 20 bought a small plot of land in Johor, imported 60 Jersey Holstein cows from Australia, and established Farm Fresh Milk Sendirian Berhad. In the beginning, Farm Fresh faced some difficulty entering the market because the local brand has doubt about Farm Fresh as a local brand. Until one day, a local retailer took a chance on Farm Fresh and made Duri's dream come true. A Farm Fresh grew in popularity and grew rapidly. He enlisted the help of an old acquaintance, Asmi Zainal, as a partner and brought in Khazanah Nasional, the Malaysian government strategic investment agency, as investors in the company to help extend its business.
Hi, my name is Nur Sharafana Husna binti Shahrudin, and I will explain the analysis ratio and differentiate between these two companies, which are Dutch Lady Milk Industries Berhad and Farm Fresh Milk Sendirian Berhad. I will analyze the liquidity analysis for both companies. The meaning of liquidity analysis is an organization's capacity to make timely bill payments is assessed during multiple ratios in a process called liquidity ratio analysis. In order to determine a borrower's or customer's financial situation prior to granting credit, this analysis is essential for lenders and creditors. The Dutch Lady's current ratio exhibits fluctuations between 2017 and 2021. Every year, the current ratio's range fluctuates slightly between low and high levels before peaking in 2021. Dutch Lady can pay its short-term debts like payroll because its current assets are greater than its current liabilities. In the meantime, from 2019 to 2021, Farm Fresh current ratio continuously decreases. A reduction in current assets, a rise in short-term debt, or a mix of the two may be the cause of this ratio's decline. So the graph shows that the quick ratio trends for both companies are fairly similar to their current ratio outcomes. The graph of Dutch Lady was a little erratic until 2021 when it peaked. An increase in the quick ratio could result from higher sales and inventory turnover. For example, you can use increased promotion, discounting, and employee rewards in sales to increase sales and consequently inventory turnover. Dutch Lady performed significantly better than Farm Fresh because Farm Fresh trend does not appear to be getting better between 2019 and 2021. This is a result of Farm Fresh insufficient liquid assets to cover its current liabilities.
3.2. The leverage. The leverage analysis relies on the explicit cost of debt. It implies that extra debt capital can be used as long as the explicit cost of debt exceeds the rate of return on capital used. Next, 3.2 Debt ratio. Dutch lady debt ratio can be seen to be quite stable in these 5 years, and they managed to get the lowest result in these 5 years in 2021. Because a company with a lower debt ratio also have lower overall debt, a lower debt ratio usually means a more stable organization with the potential to last. Although FIN420 is the opposite of Dutch lady, where we can see that their debt ratio has been gradually increased from 2019 to 2021 until reaching its highest ratio which is 61% in 2021. The larger a company debt ratio, the more indebted it is, and the bigger the financial risk. Simultaneously, leverage is an essential tool to firms to grow, and many companies find long-term use for debt. 3.22 Debt to equity ratio. As from the graph, we can find that Dutch lady and the FIN420 both have fluctuated trend on the debt to equity ratio. However, both companies have debt to equity ratio less than 1. If the debt to equity ratio is less than 1.0, then the firm is generally less risky than firm whose debt to equity ratio is greater than 1.0. A higher ratio indicates that the company is getting more of its financing by borrowing money, which subjects the company to potential risk if debt levels are too high. 3.3 Profitability. The goal of these ratios is to assess the profitability of business where the company's earnings are used to fund dividend and capital expenditure. Therefore, it will be too important to analyze this ratio. Next, 3.3.1 Operating profit margin. A profitability ratio that calculates revenue after deducting a company's operating and non-operating costs. Operating income, also known as return on sales, is the portion of sales that remain after all operating costs have been met. 3.3.2 Gross profit margin and net profit margin. The gross profit margin is the amount left over after deducting the cost of goods sold from sales. Gross profit margin is a key indicator of a company's production level efficiency. The business that has a larger gross profit margin that is rival in the industry is regarded as more effective and is also given preference. Conversely, net profit margin shows the company's net income after all associated expenses are subtracted. It can be used as determining factor, such as growing costs or competition. Next, 3.3.3 Return on asset. The fact that the return on asset is rising as the year goes on shows that the business is profitable as the future years goes on. 3.3.4 Return on equity. A greater return on equity is important and profitable for the business. Return on equity is regarded as one of the key indicators of a company's profitability. The company's inconsistent return on equity suggests that it is inefficient at making money from new investment.
Now, we move to the next part, which is comparative for liquidity. Therefore, all the calculated ratios show that Dutch Lady was a better positioned company in terms of liquidity compared to FIN420. This is because in the year 2018 and 2020, the current ratio of Dutch Lady had gone down, but later on the current ratio had indicated an assessment. The current ratio of FIN420, however, continues to decline. The quick ratio is identical for both the companies. This substantiates the fact that Dutch Lady can easily meet most of its short-term debt and can attract more companies to engage with in the future. Dutch Lady, in contrast, has much lower ratios than FIN420, so the firm may not be able to settle their debts through current assets. Next, I will explain about comparative for leverage. Comparing the ratio measure, Dutch Lady stands a better position in the frame of reference than FIN420. This is because Dutch Lady has a smaller debt burden and more solid asset position than FIN420. They are able to liquidate all of their debts with their assets. Despite of increase in debt ratio in the year of 2018, Dutch Lady possesses the capability to calculate a decreasing debt ratio for the years to come. It may make them more profitable because they will have a less debt financing cost and secure asset. On the contrary, FIN420 failed to do this. Their debt ratio increased slightly from 2019 to 2021. This is a startling statistic. It reflects that FarmFresh has a larger fixed payment liability.
Next, I will explain about the activity ratio of the company. The ratio that results from account receivable turnover is used to assess the ability of an organization to pay off its debts. The more effective the company is at collecting debt from accounts receivable, the higher the ratio. As this table illustrates, the Dutch Lady Company has a good account receivable turnover ratio, increasing from 9.45 times in 2019 to 13.50 times in 2020. Next, I will explain about the total asset turnover. The ability of a business to generate income from its assets is evaluated using total asset turnover. The table shows that the total asset turnover will drop from 2.40 times in 2019 to 2.20 times in 2020. Because a larger ratio shows that a business is effective in using all its assets to produce revenue over time, the company is thus failing to use its assets to generate sales. Consequently, we observe that the average duration of collecting periods has decreased from 38 days in 2019 to 26 days in 2020. Since the cash cycle is shorter and the business has more cash on hand to pay its obligations, shorter durations are preferred. Consequently, the shorter duration means that the company's typical collection periods in 2020 are better than in 2019.
Next, we move to inventory turnover. The inventory turnover ratio then shows a gradual increase, going from 4.9 times in 2019 to 4.92 times in 2020. We may observe that the cost of goods sold is rising annually, but turnover is decreasing as the growing sales rate is greater than average inventory. For fixed asset turnover, lastly, in 2019, the fixed asset turnover ratio was 8.26 times, whereas in 2020, it was 5.23 times. This year-over-year decline in the fixed asset turnover ratio suggests that Dutch Lady Milk Industries Berhad was less effective in turning a profit from its fixed assets. Next, I will continue with the comparison between competitors. These two tables show the comparison of margin with the industry competitor based on 2021 result and also the adjusted margin. From the tables, we can see that the cost of sales for Dutch Lady is much lower compared to the competitor. Therefore, the company has a gross profit margin of 34% or around 5% less than the competitor. Dutch Lady's net profit margin is significantly higher than its competitors because to an extraordinary gain of 155 million resulting from the sales of land and manufacturing facilities in PJ. We substitute the average other income value of the preceding quarters, which is 2.448 million, for the other income value of quarter 4 in order to exclude this extraordinary gain from the comparison. Its operating margin, PBT margin, and net profit margin will consequently drop to 11.75%, 11.61%, and 8.4%, respectively. FarmFresh has an additional tax for previous periods of about 25.7 million. The net profit margin would have grown to 11.9% if the one-time tax charge has been eliminated. Three of the company's net profit margins differ by roughly 3 to 4% with each other, relying on the adjusted profit margin comparison.
Last but not least, for conclusion and recommendation, financial ratio analysis enables an individual to track a company performance over the year and to compare this performance with other similar companies in the same area of business or industry. However, it may have some negative aspects such as unsuccessfully representation of financial health and business analysis. First off top, this ratio probably should explain what took place in the past, allowing management and financial analysis to understand business trends. Some of these patterns could possibly assist create what a company may resemble in the future. This ratio will not be an accurate prediction of the company. For this research, follow that it is a very difficult to select any of the firm performance and measurement tools because all those formula and function have been developed for a particular firm depending on the financial strategy that the firm is utilizing. Along with the qualitative information, it is essential to note what the company goals are in the implement one of the indicated methods for calculating the company's success. Lastly, it may be important to highlight the importance of ratio analysis depending on the requirement of the stakeholder and the situational necessity. Financial statements and reports are intended to provide a label there. Numbers do not lie, and corporate industry everywhere uses financial reports as a tool to manage performance for the simple reason that they can be easier to state. This information will also indicate what areas of production, processing, and marketing the business can be enhanced.
That's the end of our presentation. Thank you.